If you look at my white hair, you can probably pick that I've been alive for 31.9% of Australia's European settlement. Now, some people are smiling and others are doing mental arithmetic. And that gives me a certain advantage because when it comes to this cycle in the economy, I'm old enough to remember all 6 post-war recessions. Let's start with the most recent and see how many people can claim veteran status. The recession of 2008, I know technically it wasn't a recession, but it felt pretty tough at the time. 91, 80, 74, 61, 52. Oh, good on you. And you know when you've been through 6 recessions, what stands out in your mind? None of them lasted forever, but people said at the time they would. And I'm also old enough to have been through 6 booms in the Australian economy, and guess what? None of them lasted forever, though people said they would. And pretty clearly tonight we're going to talk a little bit about cycles. Now here is the title of my talk. I'm going to talk for precisely 40 minutes. Anyone else become obsessed with punctuality as you get older? And then we'll have 20 minutes of questions. My talk is to reflect on 50 years on investing and offer a thought on what might happen next to shares and interest rates and currencies and housing. A little over 50 years ago, January 1962, anyone remember it? The Beatles were at the top of the popularity. Suddenly Australian boys decided crew cuts were out and long hairs and Liverpudlian accents were in. But in January 1962, I was invited to address an investment conference, a residential conference at the University of New England. And I got to give the very first talk at that conference. Do you know why? We were going to spend 3 days calculating price earnings multiples, earnings yields and dividend yields. So I gave a talk on how to use the slide rule because there were no calculators and no computers. So it's 50 years. And I'd just like to share with you 3 or 4 lessons I've learned from half a century in investing. I could talk or I could show the bruises. Which would you? I'll talk. And there's a disclaimer. Well, the first thing I've learned from 50 years of investing is the magic of compounding or the magic of compound interest. Do you know the saddest thing about the magic of compounding? By the time you're in your mid-50s or early 60s and have learnt it from your own experience, it's too late to turn it to your advantage. And to underline the magic of compound interest, may I tell a story from my own youth? I was a student at university from 1958 to 1962. And looking back on those 4 years at university, I've estimated in total over the 4 years, I spent $2,000 on girls and beer. Over 4 years. I was a cheap date. Money went further in those days. The girls didn't, alas, but money did. But looking back on those 4 years, you know, Westfield listed on the stock exchange, the Sydney Stock Exchange, in June 1960. And if instead of spending $2,000 on girls and beer, I'd invested in Westfield, reinvested the dividends and didn't have the tax office to support, do you know what my $2,000 would have been worth in 2006 when the share got to $24? On Westfield's calculation, it would have been $320 million. Now, I wouldn't have the memories, but which would you rather? But when you talk to your children or your grandchildren or your neighbour's grandchildren, get over the magic of compounding. A second thing I've learnt and relearnt, I've hinted at earlier in this talk, and that is there'll always be cycles in the economy and investment markets. Do you know what too many people in business and too many investors believe? They recognise there's been a cycle right throughout their working lives, but the future miraculously will be a smooth trend line. And when you think about it, that's the least likely of all possible outcomes. There always will be cycles for at least 2 very powerful reasons. One is we're human and we're affected by other people's optimism or pessimism. Now, not 100% of people are affected, but most are. And don't you think if you go to dinner parties and everyone's talking about how house prices are going up, Isn't it easy to become part of that and want to invest in housing? If you go to Sydney in, say, 1990 and Sydney a year or two ago and mentioned house prices, everyone started to shake and look unhappy. And wasn't it easy then to become very negative about house? So we're human and we're affected by others' optimism or pessimism. The second reason why cycles will always be with us is governments. It's in the nature of governments often to do too much too late. And I think we're seeing that in some of the big countries now. The US economy has avoided a double-dip recession, but policies, both monetary and fiscal, are highly stimulatory. And in a few years' time, people are saying, goodness me, in 2013, they kept those stimulatory policies for too long. And I think that's also going to contribute to the next cycle. So they're the two big lessons I've learnt and relearned. I'll come to some others soon, but I want to illustrate about these cycles, because one of the most important things for investors is to allow there are cycles and to try to say, where are we on the cycle in shares or the cycle in housing? Everyone has seen a stylised cycle like this. Incidentally, if anyone's interested in this, John and his colleagues will have a copy and be able to email it to you. Everyone has seen a diagram like this. Just focus on the red line and look at the dots. The point, start with the bottom left and see where it says caution. That's probably where we are on the current cycle in shares. And over time we'll go to overconfidence, then greed will take over and people say, this is easy money, let's borrow to buy more. Then the market will start to turn down. At first people will say, this is not a serious downturn, it's just a minor hiccup, it'll come back. You go through denial, despair. Then you get to a point in the cycle where people say, this time it'll go down forever. And of course you get to absolute desperation and it turns again. So it's in the nature of the share market to go through those sorts of cycles. Now, of course, no two cycles are ever the same. But do you know what happens when one cycle finishes? The next cycle begins. And too many investors, I think, take the belief that when one cycle finishes, we're in a lovely straight line trend, up or down, but once the next cycle begins. Now let's go from that stylised cycle to the real world. This is the Australian All Ordinaries Accumulation Index going back to 1900, so it's 112, 113 years here. You've often seen a graph like this, but you know what I've done here? I've taken inflation out. So this is the share price accumulation index after you deduct inflation. And don't you think that's a fair thing to do? Because you think of the 70s and 80s. Anyone remember the 70s? Jim Cans? Does that sort of bring back fear and apprehension? But no, it's 1 year there we had 18% inflation. And you've got to deduct that. And so when you deduct it, and don't forget this has got dividends reinvested in it, you see the horizontal red lines? It shows how long you'd have to wait in shares to get your money back if you invested at the peak of a boom. So this graph shows what the share market returns are after you take inflation out. And in particular, it shows that the cycles are deep. See, in the 70s and the 80s, the fall in shares was 65%. That's after you take inflation out. And it took 15 years to get your money back. So the cycle in the share market are pretty big. And that gives rise to a very important question. How can we cope with cycles? And I've put here 6 or 7 ideas how to cope with cycles. And you should see this as analogous to the menu in a Chinese restaurant. You know, if you go to a European restaurant, you either have chicken or steak or fish. But this is a Chinese type menu where you can have a little bit of everything. So we've got to cope with cycles. There'll always be cycles with us. And as we've relearned in the last 5 years, some cycles are very big. So how do we cope? Well, one thing is don't buy in boom and sell in gloom. I know it's easily said, but everyone knows people that did get carried away in a boom and gave up at times of gloom. And it happens every cycle. Also look for some good counter-cyclical opportunities. There are times it pays to be an investor that goes against the general perception of what's happening. You know, sometimes the best way of buying a property is when there's a mortgagee in possession sale. And you may find an article in The Age as you go to that sale, to that auction, that says there'll never be another recovery in Melbourne house prices. And they're the sort of times that you've really got to say, hey, there is a cycle and I'm going to be counter-cyclical. And do you know who was Australia's best counter-cyclical investor? It had to be Kerry Packer. Remember that observation, what a pity you only meet one Allen bond in a lifetime. And if you think, though, Jamie Packer and his big pro-cyclical investments in OneTel, that was a typical pro-cyclical investment, you're reminded that counter-cyclical investment skills are not passed on with your genes. We've all got to work on trying to be better at counter-cyclical investments. Do you know that in the last 18 months, Commonwealth Bank got down to $48? The last 15 months. Combank got down to $48 and people didn't want anything to do with it. There was so much gloom. Also have a sensible diversification. The cycle sometimes is very tough. Having a sensible diversification, even if government bonds look unattractive, they can be very helpful when the share market falls apart. Also have enough safe assets to draw on in gloom. When people retire, they need enough safe assets to draw on for the first few years of retirement rather than have to sell some of their quality shares just to live on. Also, don't extrapolate a phase of the cycle and call it a new trend. How often do you hear words, we're in a new era or we're in a new paradigm? Be very careful about those concepts because the cycle tends to live on. And you know, my view after 50 years of investing is when you hear our fellow Australians say we're in a new paradigm, climb under two tables. Because by the time most of our fellow Australians can spell the word, it'll all be over. But here's something a bit more controversial. Coping with cycles, I think, requires that we put emphasis both on time in our investments and timing our investments. Everyone in Australia's heard the advice, everyone in Australia's heard the advice, time in the market is more important than timing the market. But think of that graph I showed you. Sometimes you've got to be in the market a very long time. And I'd like to put it to you that both time in the market and timing the market, they're both important. Time in the market is something we're all brought up on, and it has its merits. Because if people are advised that time in the market is important, they're prepared for the fact there'll be good times and bad times. They're not expecting everything would be good. And the phrase, time in the market is all important, warns people against selling in extreme gloom. But you've also got to say, can people really wait up to 15 years before they get their money back, given how big the cycle is in shares when you take inflation out? And some cycles are deep and painful. So I think it's sensible for people to try to say timing the market should be part of their investment decisions. In other words, every few months people should say, is my allocation to shares and property and overseas shares and bonds and other fixed interests, are those asset allocations correct? Should I make some small adjustments up or down? If shares are running ahead, cut them back a bit. If shares have really got a lot of gloom in them, say, should I be topping up? And at the very least, we always need to be aware of the dangers of buying into markets that are already booming. I mean, don't you think that was the big lesson of 2006, 2007? The share market was very strong. People were buying into a market that was booming and it was very uncomfortable. So I'd like to leave you with the thought, time in the market is as important as timing the market, and we should give some thought to both.